Hello, it's very nice to be back with you again. I'm Bohnsack, the President and Head of Portfolio Strategy for Strategas, Baird's investment strategy arm. Last week we visited on the strength of the economic recovery and our firming conviction that the building blocks are in place for the economy to transition from recovery to expansion, as we evidence the sustained improvement in activity, demand, output, revenue, and profitability. And while the next several months may turn out to be choppy for the equity market, as we grapple with what we might call a logistics gap for a vaccine that is approved ultimately, but not readily available, it gives us a moment, as one does at year-end, to step back and consider some of the longer-term drivers of economic activity and market performance. You know, the Baird mailbag is full of wonderful questions on all manner of topics, and we encourage you to keep them coming. But grouped by topic, few stacks would reach higher than the number of questions we receive on inflation. Decades of economic theory has allowed two conclusions to become viewed nearly as fact on the inflation front. One, that the rapid growth in the money supply relative to insufficient outlets for capital causes inflation. Said plainly, too much money chasing too few goods causes prices to rise. And the second conclusion is that in developed economies, particularly like the United States, which enjoys a reserve currency status, we just don't have to worry about inflation anymore. Or perhaps not. But this conclusion rests on two ideas. The first is the power of the Volcker tools to curb inflation through interest rate policy. And ironically, the second is that the impact of negative interest rates makes it all but impossible to induce an inflationary environment. Consider Japan. But let's take a look at this chart of the year-on-year rate of change in the M2, or the US money supply. There's a mathematical term for how sharply the slope of the line has increased, but some would not consider it in good taste to utter here. I'm kidding, of course. The term is asymptotic, and you should think of it as increasing at an increasing rate. And to the point, the Fed's balance sheet has increased roughly 70% since Labor Day, and Congress is debating the finer points of another $1 trillion stimulus bill. Policymakers don't seem at all bothered by the potential long-term implication of all this money printing. Perhaps it's due to the short-term deflationary impact of the pandemic, fewer wages, less demand, or perhaps it's due to the natural proclivity of politicians to give things away. Or maybe, because we haven't seen inflation in such a long time, our instruments of detection aren't properly tuned. What we do know is there appears little evidence to suggest that the regress of monetary or fiscal policy is set to reverse course anytime soon. So the money supply keeps growing. And while this next bit could be viewed as controversial, we view the low probability of the Fed instituting negative rates, like Japan, as a key catalyst for inflation to potentially rear its head. And at the very least, as a catalyst for the US dollar to weaken further, particularly against hard assets like gold or real estate. And while you should always work with your Baird advisor for the impact on your plan, we see a strong case for including gold or other inflation hedges in their portfolios. We added a small position in gold ourselves to the tactical allocation portfolios this summer. Now, none of this is meant as cause for concern, rather just food for thought, and a reminder that we can't forget the things that haven't been around in a while. You never know when they'll sneak up and surprise us. Stay focused, stay healthy, keep the questions coming, and we'll see you again next week.